Well, greetings and salutations, test takers. This is the Series 7 Guru coming to you from my off-grid undisclosed location with another explication request. If you have an explication request for questions, send it to explicationrequest@guruexamprep.com. This is the question for today's explication. An investor purchased 20 XYZ Corporation 6% convertible bonds for 97 that mature in 20 years. The bonds are convertible into 40 shares. However, 3 years after the purchase, the corporation has declared a 20% stock dividend when the bond was trading at 105. Then 6 months later, the investor decided to convert the bonds when they were trading at 104 in the stock and sell the common shares, which are trading at parity. There's no draw in your Series 7 in which you're not going to have to calculate parity, and you can't be fumbling around with how to do that. You might have to do it more than once. What is the capital gain or loss on the bonds and the conversion price of the shares? All right, well, let's break it into its component parts. First thing to notice here is we've had this investment been at risk for more than 12 months. And so we know the capital gain is going to be long-term. And that can help us with a 50-50. Maybe I shop the answer set, and there's two that say short-term, two that say long-term. If so, I have a 50-50. All right, so we're going to have to deal with the conversion price, and conversion terms are based on par. So when the bond was originally issued, the conversion price was 25,000 divided by 40 shares. 970 divided by 40 is what I would be into the stock for. That's called parity of the stock. And so if I convert, that's what I'd be paying for the stock. However, they can declare a 20% stock dividend. And the trust indenture, the contract between the issuer and the trustee for the benefit of bondholders, there's an anti-dilutive provision which says they're going to have to adjust my conversion features for any stock dividends or stock splits so I can convert into the same proportion ownership. So the new conversion ratio is 48 shares, 8 additional shares. Now I can answer the first part of the question. 1,000 divided by 48, I have the answer to the adjusted conversion price, which is 2083. So now we got to work on the second part of the question. It says we convert in the stock when it's trading 104. Now we're going to have to do parity again because they're making us work for the current market price of the stock instead of just giving it to us. So now I have my adjusted cost base per share, 970 divided by 48. And now I got to figure out what parity is because they told me I converted in the stock and sold the stock and the current market price was parity. So I do another parity calculation, and that means the common stock was 2167. So I had to do parity basically twice in this question. Once when I bought it and one to determine the current market price of the stock when I sell. Looks like I'm a happy camper. If we compare those two numbers, my cost basis was 2021. My sales proceeds are 2167. I made $1.46 on 960 shares. Where am I getting that? Remember, I have 20 bonds. Each of those bonds are convertible into 48 shares. 48 shares times 20 bonds is 960. So that's the second part of the answer. I have a long-term capital gain of approximately $1,400. Depending on how you round, you might be off $1 or some change, but always pick the one that approximates your LED display. If you don't have a Kaplan Q Bank, I highly recommend it. With my 15% discount at checkout, you can get it for $55.80. If you're looking for a free supplement, the best free supplement to your paid study materials is my YouTube channel. Remember, inch by inch, your Series 7 is a cinch, yard by yard. Your Series 7 is hard, and I'll see you for the next explication request.